Welcome back to the 980s podcast hosted by yours truly, Kevin Thompson, founder and CEO of 980 Capital Group. Thank you guys for joining me. As I always say, subscribe to the channel. As I always say, go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@980capitalgroup.com. Send us your questions. Go to the website at www.980capitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 980cap or at MLB to CFP. And subscribe to our Substack. Now what? Man, we have a lot to talk about today, but today we're going to be talking about the IPO bonanza, what to expect, and how to protect yourself in this current environment. This is going to be a big one, so let's get it. We're here to talk about the IPO bonanza. It's back and it's better than ever because, again, it's always that lottery ticket that everybody's trying to see. You're hearing names like SpaceX, Anthropic, OpenAI, Databricks, Stripe, and a handful of other private companies being discussed as potential public offerings over the next several years. But here, for a majority of retail investors, this sounds exciting. Finally, a chance to buy into the next generation of transformational companies. But whenever Wall Street comes knocking at your door, I think it's important to ask yourself one simple question. Why now? Because when you understand who owns these companies and how private markets work, the story becomes a little bit more complicated. Let's start with who currently owns these businesses. When people hear private company, they often think about founders working out of their garages, people that are just getting together in groups and just building something amazing. That's not what we're talking about. Many of these companies are already owned by what we call venture capital firms, private equity firms, sovereign wealth funds, pension funds, university endowments, and other ultra high net worth investors. One thing I've always said is the gains have already been made. Right? These people on the ground floor, the gains have already been made. Some of these investors got in at valuations that are a fraction of today's levels. In many cases, they have held these investments for many, many years. And eventually, every investor wants that liquidity event, that exit. Every investor wants that exit. The easiest exit, sells shares to the public. Now, that's not necessarily a bad thing. It's not a bad thing, trust me. But again, public markets serve an important purpose. Retail investors need to understand that IPOs are often less about allowing you to participate and more about allowing someone else to cash out. Historically, there have always been safeguards. Companies generally had long lockup periods. Indexes had to wait a year or possibly two before even adding those companies. There had to be profitability expectations and trading history requirements. The goal was simple: allow the market to discover fair pricing before forcing index funds and retirement accounts to buy the stock. Today, there's a vast difference. Main differences I'm seeing right now, especially in the SpaceX IPO, is that there's accelerated lockups, which means instead of having that 180 days lockup provision, there's provisions that are allowing them for a 70-day distribution, 90 days, 120 days, allowing insiders to sell at an accelerated rate. When you hear those types of things, you have to understand, why are they allowing this? Why are they allowing insiders to dump so aggressively? That's one question you need to ask yourself. For me, I see it as more of a exit liquidity event, having these companies put supply onto the market to the retail investor. But again, if this investment was such a great opportunity, why are you aggressively trying to sell it so quickly in the market? That's one question I ask myself. But another thing is, again, things matter, right? The guardrails are starting to disappear. We're seeing accelerated inclusion into indexes, especially with SpaceX. They're trying to get into the NASDAQ and the Russell 2000. We're seeing discussions around shorter lockup periods, like I just mentioned. We're seeing faster pathways into major indexes, and that matters for us, the end consumer. I do a lot of investing for clients, and I think that it's important to understand why that matters. So, because once a company enters an index, passive money has to buy it. Think about all the money sitting inside the S&P 500 index funds. Think about retirement accounts. Think about pension plans. Once the rule triggers inclusion, that money becomes a mandatory buyer, right? Not because the company is cheap, not because it's profitable, simply because it entered the index. That's where things get interesting. Take SpaceX, for example. By any measure, it can be an incredible company, right? It can be an incredible next generational tool, talent, whatever you want to call it. Elon could be the greatest man since sliced bread. It has transformed launch economics, right? Starlink is changing global communications. The company has accomplished things that most people thought were impossible. But being a great company and being a great investment are not the same. The valuations discussed around SpaceX have been increasingly aggressive. Private market estimates have floated numbers approaching over $1 trillion. The last time I saw it was $1.7 trillion. What that basically means now, again, they're only floating 4% of the company right now. But again, you have to understand that this is very aggressive. Yet investors should remember that much of the valuation is being determined in private transactions with limited liquidity. That's very different from having millions of public investors determining price every single day. History gives us examples. Like I mentioned this on Yahoo Finance recently. Now, I didn't really get the point across, but I talked about Tesla. Tesla had a great IPO, right? It's done very well since then. But once it got to those lofty valuation metrics that it went over $1 trillion, like think about it back in 2021, it's been roughly about 3% in regards from 2021 till now. It hasn't done much for a lot of those retail investors that bought in 2021, right? It hasn't even come close to the S&P 500. So I wanted to say that because, again, in 2021, we had massive IPO booms. A lot of those companies have lost 60%. A lot of those mega IPOs lost 60% of their overall value. Always remember this. I think this is very important to have a conversation around. Always remember this. Every company had the IPO at one given time. There's been a lot of companies that IPO'd that did well. And there's been even more companies that IPO'd and you never heard about. They went back to zero and went bankrupt. Companies right now were coming to market, especially in 2021, at eye-popping valuations. Many were losing money. Many were being sold on future growth. Investors were told they were buying the future. The reality showed up. Many of those stocks, like I said, fell 50, 60, 70, even 90%. These businesses may have been innovative. The problem was the price. Price matters, valuation matters, and eventually fundamentals matter. Even some successful IPOs remind us of this. Let's look at Facebook. Today, it's one of the most successful companies in history. But after the IPO, the stock struggled for months as investors questioned valuation and growth assumptions. The company ultimately justified the price. Many others didn't. Look at Uber, Rivian, Robinhood, and even Coinbase. Excellent examples of companies that entered public markets with tremendous excitement and valuations that were difficult to support. Some recovered, some haven't. The lesson is simple. A great story doesn't always equal a great investment. So why are we seeing renewed enthusiasm for IPOs today? Well, let me break it down to you. When I think about IPOs, I think about them in three contexts. The first one is venture and private equity. If you look back at how venture and private equity, they were awash with cash back in the early 2020s. I mean, the amount of money that was going out from a stimulus perspective and the amount of money that was created, that money found a home, and now they're looking for exits, right? They have been stuck finding exits. Exit activity slowed, mergers slowed, acquisitions slowed, interest rates rose. Many had to rethink their strategies going forward. but money became more expensive. At some point, investors need to realize gains. Second, AI has created a new narrative. Artificial intelligence has become one of the most powerful investment stories since the internet. And if you follow me, you know how I feel about AI. You know how I feel. Again, I'm a fintech dystopian like Hillary Allen. I typically believe that it's one of the greatest stories that has ever been told, ever been sold to us as consumers as the next greatest thing. But every company wants exposure to it. Every investor wants exposure to it. And Wall Street understands that demand. Third, public markets are willing buyers. Index funds, ETFs, retirement accounts, and retail investors represent a massive pool of capital. The public market can absorb enormous amounts of supply, which brings me to the biggest point. Whenever you see insiders rushing towards liquidity, ask yourself why. If the future is so extraordinary as advertised, why are so many early investors looking for exits? Maybe they aren't abandoning the company per se. Maybe they're simply taking profits, and that is absolutely normal. But it should also remind us as retail investors that the easy money has already been made. The venture capital investor who invested $5 billion at a $5 billion valuation is playing a very different game than a retail investor that is buying at a $500 billion valuation. There are not the same opportunities. Those are not the same risk profiles. So what should investors do? First, don't confuse innovation with valuation. Second, don't chase headlines. Third, remember that every IPO has a seller on the other side. And finally, understand when Wall Street starts offering you access to something that was once exclusive, you should always ask yourself why that access suddenly became available. The IPO market is back. These companies are fascinating. Some will change the world. Some will become trillion-dollar businesses. But you have to understand, if they're already being floated as a trillion-dollar valuation, has all of the growth already been included in that valuation? History tells you, especially me, that buying great companies at the wrong price can still produce terrible investment results. We're all looking for the next Amazon or the next Google or the next Tesla or the next what have you, because we can put $10,000 down and become a millionaire. That's the story that's consistently sold. But no one ever talks about the hundreds of other companies that IPO'd that went to zero. The gains that created the headlines may already belong to someone else. Your job is to determine whether that's enough or if there's enough upside left after everyone else has gotten rich. That's the question retail investors should be asking. And that's where I'll leave it today, because it's important to understand that valuations matter. Fundamentals matter. And if you're chasing headlines, you may be left holding a bag. Thank you guys for listening to the 9 Innings podcast. Subscribe to the channel. Go and get my book, MLB to CFP, live on Apple and Amazon. You have any questions, comments, or concerns, you can email us at info@nineeyecapitalgroup.com. Send us your question. Go to the website at www.nineeyecapitalgroup.com. Schedule an appointment. As you know, we're here to do what? Educate, empower, engage, and also entertain. Follow us on all social media channels at 9EyeCap or at MLB to CFP, and subscribe to our Substack. Now what? Today we talked about the IPO bonanza. Bonanza, and what you should be looking for. Understand that not all investments are going to go to quadrillion. Understand that why are the insiders selling if something is so valuable? And understand that the insiders are the people that are about to get rich. And it may leave you with peanuts. Thank you guys for listening. Stay humble, stay safe, my friends. I'll see you again soon.